afternoon, everyone, and welcome. Thank you for joining us today for our webinar, Why Later is the Most Expensive Word in Strata. My name is Gemma Davey, and I'm very pleased to be joined with two highly respected professionals in the industry for what promises to be an insightful and practical discussion on the real cost of delaying decisions in Strata. We have Paul Morton, Lannock founder and CEO, widely recognised as an expert in strata finance and assisting owners corporations make better financial decisions. He is a regular contributor to industry forums and is passionate about educating strata communities on corporate finance and tax matters and truly understands the impacts of delayed works. We also have Mitchell Lipscombe, COO of BAC Insurance Brokers, one of Australia's largest strata insurance broking firms. Mitchell has 18 years of experience across insurance broking, strategy, operations, and leadership. Mitchell holds an MBA from AGSM, is a fellow of ANZIIF, a member of the Australian Institute of Company Directors, serves on the board of the SCA, and is always keen to contribute toward discussions that elevate the overall industry for the benefit of the communities that we serve. So together, Paul and Mitchell offer a powerful combination of financial and insurance expertise, and I'm sure you'll gain valuable insights from today's discussion. We have the Q&A chat box open throughout the session, so please pop any questions in and we'll answer them at the end. Before we begin, we would like to note that the information shared today is general in nature and should be used as a guide only. We recommend seeking independent professional advice tailored to your specific circumstances. So let's kick it off with Paul. Welcome.
Oh, thanks, Gemma. Well, we have 400 people on the call here today, and that tells me two important things. One is there's a lot of people interested in this topic. But the second one, even more so, is I reckon I'm preaching to the converted, because you are the people who already know and recognize this problem. I don't think you joined this thinking, oh, I'm not sure about that. Oh, I don't like that. Oh, well, I better go on and find out what it's all about. I think most people here today joined because they recognized this is a problem. What can I find out more? So it's not really a matter of me telling you what you already know. It's a matter of how I can perhaps help you to convince others. First, the strata committees that you're working with, and then the owners in general meeting. So why is later expensive? It's not rocket science. There are two major things. One's inflation, one's scope creep. There's a few others, but let's take the major ones first. Inflation. We all know that prices of things only go up. We haven't had deflation in Australia for a very long time. We had 1 month of deflation in 2020 because of the pandemic, but before that it was 1998, and before that it was 1962. Inflation is not going to go down anytime soon. But we need to pay attention to something I'll call strata inflation. There are no stats on this, but I'll give you some real life examples. For example, in Campbell Street, Parramatta, a rectification which in 2016 was expected to take $1 million. It did not proceed. They decided not to do the work. 7 years later, in October 2023, they resolved to borrow $5.5 million. Of course, the examples are from people that we speak to. It was the increase in cost of material and work from 2016 to 2023, and partly the insurer advised them they'd not renew the policy if the works weren't carried out. Another example I've got is Abercrombie Street in Darlington, which is also in Sydney. That was expected to cost $500,000 in 2023. They resolved to proceed, but they didn't commence the works because they all wanted to see if they could raise the funds by a special levy. Late in 2024, only about 18 months later, that 500K became 1.5 million. Delaying works. Flinders Street in Melbourne, rectification was expected to cost 250K. They approved a loan in 2022. They had to increase it to 1 million in 2024. Delays because of the additional work and additional defects caused by the delay. So what's behind this strata inflation? The works we get done on strata properties are not subject to the same price increases as the loaf of bread we get at the bakery. That loaf of bread is subject to CPI, the Consumer Price Index. Construction costs have outpaced CPI. We have labour, materials, international transport, prices of trades, all of these things. In the last 10 years, CPI has gone up by a cumulative 30%. Okay, that's a bit scary. But LMI, the Labour and Materials Index, only took 4 years from 2020 to go up by 31%. This is what influences the inflation of costs in strata. It's not just the cost of living as we usually talk about. The next is scope creep. Look, it's so obvious, but we forget it. What happens when the roof leaks? The answer, you get wet. But when wood and metal have been continuously wet for a long time, we get other problems: rust, rot, mildew, mold, you know the things that happen. So fixing that roof becomes rectifying that beam, repairing that gyprock, replacing that carpet, and so on. And there's another element of scope creep. We often ignore it. For the sake of a better word, and just for today, let's call it regulatory scope creep. Government regulations are adding to the cost of investigation, the detail you need to have in a contract, and sometimes even the scope of works. Whether or not you think these new regulations or codes are good or bad, doesn't matter whether you agree with the motivations behind them, that's not the point. The practical thing is we are not going to have fewer regulations, and we're not going to have simpler compliance. It's only going to go the other way. For example, combustible cladding rectification, post-Grenfell and lacrosse, waterproofing, defect remediation, fire safety upgrades, electrical compliance, asbestos handling, and now EV charging infrastructure. These are why strata inflation is different to normal inflation. There's a few other things. So part of it's supply and demand. Trades are getting harder to find. It seems there's more work to be done and less people to do it. And our apprentice system seems to have gone down the gurgler at the same time as there are huge infrastructure projects underway which suck up labour. You know, the Sydney Metro, for example. And things can be more complex in strata. For example, a rectification in strata often means that people want to stay in their lots while it's being done. Whereas in other types of properties, the work might be done when the lots are uninhabited. That adds cost. So if we're not going to delay these things and do them later, when are we going to do it? It's very tempting to say now. It's not quite that easy. I don't think strata, owner corporations, unit titles, bodies corporate, etc., is going to be better off if we say, do it now, it's urgent, it's a crisis, get it done now. It is urgent, it is a crisis, but we all know what happens to fools and angels when it comes to treading. So how do we make sure that we're on the side of the angels? I think it requires a change of attitude. What attitudes do we and our committees and our general meetings have that need to change? I think the first one is really simple. It's all in the words we use. Substitute some very bad words for one very good word. And the bad words, thanks for asking, are cost and expense. We are psychologically wired like Pavlov's dogs to think cheap when we hear those two words. If this costs money, if it's an expense, how can we get it cheaper? Beep, wrong. Cheap and nasty are in the same sentence for a reason. The good word, the right word, is investment. Just a simple change in language and suddenly we're on the right path. Because when you think investment, you must immediately think return. What's my return on this investment? And positive returns on investment make the property more valuable, which means we all become more wealthy. Which leads us really nicely to the second important change of attitude. So often we make decisions, especially economic or financial decisions, in an environment of scarcity. We set a budget, or the budget is set for us, and we try to squeeze something into that budget. That's wrong too. Forget about your budget. Forget about your bank balance, as weird as that sounds. Forget about sinking funds, special levies, and strata borrowing. They're not important in this context. Each of them has pros and cons. Some will, some won't be right for you in your situation, but put them to the side and use your imagination. What investment will give us the greatest return? Do what the treasurer and the finance director of every global corporation do. Work out the project. Work out the right means of dealing with that repair or rectification. Work out who's the right contractor, all with return on investment in mind. Line all your projects up, work out your return, both financial and emotional, and choose the projects that give you a positive return. Now, and only now, do you turn your attention to the means of financing. What are the pros and cons of a sinking fund or CapEx fund in your situation? What are the pros and cons of a special levy in your situation? And what are the pros and cons of strata finance in your situation? Now, this webinar is not about the details of these pros and cons of funding capital works, and do that another time. We've done it before. But let's take first things first. All we need to know for now is that we should be making decisions based on ROI, and that the three funding alternatives have pros and cons. So why did I say that the opposite of later is not now, even when the work is critical and urgent? It's because we can't ever skip the planning stage. What's the right project? Who's the right contractor? These things will have a critical impact on your ROI. But for the enlightened people who make up the population on this webinar, planning and analysis are not enough. The other critical part of the foundation is owner engagement. How many times have you presented to the committee or the committee's presented to the general meeting with the right, perfect project, only for it to be voted down? I guess it's happened to everybody on this call. There are as many ways of engaging your owners as there are strata schemes, so I'm not going to go into that. The important thing is to recognise that engaging owners is necessary. You can have information nights, models set up in the foyer, presentations by experts, all these things, put notes under their door, be creative. But let's have a checklist of the things that your engagement solution will need to include. You're going to have more success if the owners actually recognise there's a problem. What? The roof leaks? Well, no one told me that. I know it sounds so trivial to put it in those terms or even flippant, but that's where some owners are. And then they need to recognise the implications of the problem. So you're really telling me that legislation says we have to fix this yesterday, and that if we don't, it will get worse and cost more? I didn't know that. When I say it like that, it seems trite. But many of our owners are in that position, and we have to deal with where they are. And in New South Wales now, lucky people, the government can come into the apartment and require the work to be done. I think it's really useful to give them options, or perhaps even better, let them know the work that you've done in considering the options and why you've rejected all but the one you're proposing, and explain why it's the best in your situation, and then you can bring things to a close. What's the big lesson? Don't assume that others know what you know, or that they see things the same way that you do. Look, I've made this sound as if it's all possible in a nice, neatly wrapped PowerPoint presentation. We all know that's not the case. In your engagement plan, try to work out how to provide the information, how to deal with the questions and comments, and sometimes they'll have a way to improve it, and when to call for a decision. Often it's best in complex situations to separate these steps, especially separating the decision time from the information and the understanding time. Some people decide things early, others take their time. Don't bore or frustrate or anger the people who have decided early by making them sit through the questions of the slower people. Don't push people into decision mode without giving them the opportunity to work through the issues. What happens when you delay? And when you settle for later? Well, we have unhappy people. Now, look, people might or will whinge and complain about having to get capital works done. But that's just a process. If the works aren't done, they're going to stay unhappy. There's also the lost lifestyle. Whatever it is that you're delaying on, that's time out of your life, time that you're not going to get back. And reduced income, and reduced capital value. And insurance costs are very, very likely to go up. Remember, CPI took 10 years to go up 30%. LMI took just 4 years to go up 31%. But anecdotal evidence is saying that in strata insurance premiums are going up by 15 to 20% each year. And later, with respect to capital works, is a very important contributor to that. So by raising the I word, seems like a pretty good time to hand over to my partner in this presentation. Over to you, Mitch.
Thank you very much, Paul. I really like the reframe concept, as in reframing expense to investment. That's really cool. I also wrote down, I like that you had some themes about planning and owner engagement. Before I talk about the specificities of it, I think those two concepts as an insurance broker are music to my ears, in the sense that the more owner we can get in an insurance renewal or insurance placement, and the more we can be strategically planned in that concept, the better the outcome is for everybody. So Paul's just kind of spoken about the escalating costs associated with the term later. What I want to do is just chat briefly about the insurance lens of that, which somewhat reinforces a lot of Paul's messaging. There comes a time where maintenance or defects or issues like that fall outside of maintenance, defects or issues like that and into the insurance space. And just to contextualize that, what I'm kind of talking about is anything which needs remediation, whether it be corrective maintenance that's about to move into the reactive category, whether it be outstanding building defects, whether it be fire orders, whether it be combustible cladding. All of these things are already sometimes a concern for the insurance market, but when you add the word later to those concepts, they become more of a concern. Now, each of the words I just said are very different in nature, and the reality is the insurance market will evaluate them based on their differing risks. But practically speaking, the insurance market really only has certain levers it can use to treat their perception of these things. First, they look at things such as the desirability of the risk, if it falls within their appetite. So they may look at outstanding kind of maintenance issues and determine, well, do we even desire to insure this building? The second is, if they choose to, on what terms will they insure the building? So they're starting to evaluate that as well. And finally, importantly, they start to consider how to price accordingly for the risk. And often the perception will be, the more the word later is used, it kind of gives an impression of the risk orientation of the committee or the people making the decisions, which typically leads to a higher perception of the overall risk of the building. To unpack it a bit further, I thought maybe it'd be wise just to sequence the discussion across three key pillars, as in the why do we even tell insurance companies about this? Then the how, like how insurance companies or how the market going to respond to these things. And then more practically speaking, like what does this mean with respect to the insurance product? So to talk about the why, because I often face questions from customers or my strata manager partners as to why do we even have to tell the insurance market about these kind of matters? And when does the time come where I need to tell them based on what they already might assume? So fundamentally, insurance contracts across this great nation are governed by what they call the Insurance Contracts Act. That is a federal piece of legislation, and it governs both sides of the contract, the insurance company and the insured. So in our context, like owners corporation or body corporates, Section 20 and 21 of that legislation requires the insured to notify the insurance company of any matter that a reasonable person may consider relevant to that insurance company's decision, whether or not to accept that risk, and if so, on what terms. Now, there's some deviation depending on the type of contract, but fundamentally, if there is something that's relevant to the insurance company's decision, you need to notify the insurance company. That's why the language and the discussion and the dialogue surrounding the word later is very important. Now, the strata insurance market is somewhat underwritten on the basis that insurance companies know that in most jurisdictions, the legislation requires the owners corporation of the body corporate to repair and maintain common property. But when that repair and that maintenance starts to become delayed, and we move from kind of proactive maintenance and proactive kind of upkeep to more of a reactive type of thing, you start to encounter obligations under the Insurance Contract Act to tell the insurance market. So long story short, that's why we need to know. That's why brokers are going to ask you. That's why the insurance market's going to ask you. It's to satisfy the owners corporation, the customer's obligations under the legislation. So we start to move to then is how. Like, how will the insurance market start to interpret what they've been told? And to talk about this, I always think it's important to contextualize where we've been as an insurance market. I kind of like anecdotally say that 10 years ago, or maybe 2015, it was a kind of a fun time to be a strata insurance guy. People were your friend. Premiums were going down. Everybody was pretty happy with the outcomes they were receiving. We call that the soft part of the insurance market cycle. Typically, it's when premiums go down, cover goes up. Happy days for consumers. But of course, that's not always sustainable. Following from 2015, 2016 onwards, we had a rapid escalation in the frequency of natural catastrophes. We then had a very low interest rate environment impacting insurance profitability. We then, of course, kind of like Paul said, had COVID-oriented inflation. So the cost of claims started to become more expensive. Fortunately, for a lot of the strata assets out there, we're entering into a period where there's a lot of premium stability. So we've come off the back of that hard market environment. The relevance of that storytelling in today's discussion is that throughout that 10-year period, insurance companies have got quite smart or quite considered and intentional about their risk evaluation. And whilst a lot of the market are enjoying some premium reduction or rate stabilization, when there's issues surrounding delayed maintenance, or when proactive maintenance moves into a reactive territory, or where defects remediation is getting kicked down the road, or when cladding still isn't being removed or fire orders are not being complied with, that's where there's alarm bells ringing. And that is where we encounter a lot of difficulty in the insurance market. And effectively, if I go back to the levers I spoke about before, the insurance companies are going to be evaluating what they're told in the context of that duty of disclosure against their desirability of the risk, if they are going to insure it, on what terms they're going to insure for. So they might look to apply certain excesses to ring fence like key issues. They might exclude certain coverage items. And then finally, they're going to price the risk based on what they've been told, based upon the duty of disclosure obligations. So we're in a period where a lot of strata insurance consumers are enjoying premium relief, but those that aren't taking a proactive investment-oriented mindset on these repair and upkeep matters are encountering kind of difficulties, and it's actually costing them in the long run in the context of premium increases. It turns out to be a bit of a cyclic thing, because the more you're paying on insurance premium, the less money you actually have to pay to repair and maintain the building. But let's assume that we finally get insurance and the broker or the advocate is able to kind of negotiate with the insurance market and give them comfort that the word later isn't too entrenched in the owner's corporation psyche. We then get the insurance products. And that's relevant in today's conversation because, fundamentally insurance is there to respond to sudden and unforeseen circumstances. If an owner's corporation knows about issues and it's delaying remediation, or the planning process isn't there, it's somewhat unfair from the insurance market to expect the insurers are going to pay for those losses. So typically you see in any standard insurance, property insurance products, that gradual deterioration or wear and tear type matters are excluded from coverage. That's very relevant because the more you let something deteriorate or erode or reach the end of its lifespan, the more risk you have of claims not getting paid as a result of those policy provisions. You also have certain exclusions, such as like defects exclusions, which is pretty typical. But strata insurance policies also carry construction-related exclusions. So if you have contract works on site that exceed certain thresholds, exclusions apply unless they're negotiated around. So back to Paul's point, the more we have kind of scope creep and cost escalation, the more danger you have that you're going to be in a territory where you start to trigger those exclusions. So finally, I think it's important to maybe discuss what good looks like in the context of the insurance market's perception and specifically in the context of today's conversation. Insurance or strata is fundamentally going to have maintenance issues. We have an aging building stock across the country. We have new building stock coming on that are often somewhat riddled with defective matters. Insurance companies understand that. What the market really wants to see is a proactive headspace. They want to see adequate planning. They want to see, like Paul said, the appropriate client or owner engagement to get the ball rolling on mitigating risk and fixing these issues. In insurance world, we always get a bit concerned when we see the word later or see the word deferred or see the word we're getting more quotes because we haven't made a decision, because it starts to paint a picture that the committee or the people running the building aren't sharing that kind of low risk tolerance lens that the insurance market has. Fundamentally, what we do want to see as brokers and also as how I observe the insurance market is we want to see planning, right? If there's an issue identified, if it's defects, if it's maintenance required, we want to see what's going to be happening, what's the time horizon toward material change with respect to that matter, and specifically how it's going to be funded. Gone are the days of the insurance market being reasonably patient in the context of raising special levies or funding these issues. They really want to understand what's happening. They want to understand the owners corporation has quite a healthy balance sheet to fund these issues. And if they don't, they want to understand where the capital's coming from, which I'm sure your partners at Lannock can probably assist with. So long story short, deferring issues and the word later is less than ideal in an insurance context as well. Not only are you going to have increased costs on getting the work done, you're probably going to end up having increased costs from an insurance premium perspective. The owners corporation has no choice but to tell the insurance market about these issues. The insurance market is reasonably cluey these days about what risks they're willing or not willing to insure. And then there's a big discussion surrounding what's actually happening, how are committees funding these things, and what's the general proactive mindset of the people running these strata assets. I'll probably finish up there, but I'm super keen for any questions if anyone has any.
Perfect. So before we send it over to our attendees, I'll just sort of tie some of the things that you have said today together and just ask a couple of questions to each of you. So Paul, you mentioned the different ways to fund the works, and I know you said this isn't the point of the webinar, but it would be valuable if you could just touch on what roles funding plays to keeping the costs down.
Oh gosh, Gemma, that's a whole other seminar.
Just a quick one so people get it.
I can talk for hours on this thing. It's one of my favorite topics. I'm going to dodge this question a little bit. I'm going to say it's always been possible to have a sinking fund. It's always been possible to have a special levy. And in the legislation and in the lending market for the last 25 years or so, it's always been possible to borrow. So there is no shortage of availability of funds in order to be able to do what you either need to do or you want to do. It's really then looking at the pros and cons of each of them, and I don't think actually we'll go into that, so sorry, Gemma, I'm going to ignore that, and then looking at the required attributes of your situation. For example, and this is a really simple one, do you need the money now or is it in 10 years' time? And also, that's the beginning of a list of attributes, timing. Another one perhaps is just, what are your objectives? And this is something that I don't see very often when people start to talk about funding. No, is your objective to have the lowest possible risk? Is your objective to have the lowest possible cost of funds? These things actually sort of start to play in because you've got one person saying, well, I want to have the such and such. And the other person saying, oh, I want this. And then it's a matter of, but why do you want that? What is your objective in seeking this? Now, oddly enough, most people want low cost of funds, but it's not the only thing which is relevant. The other one which really, really gets to me is why owners are not taking after-tax cash flows into account. Now, it's really weird. We've got a number of New Zealand people on the call, and I'm not familiar enough with New Zealand to know how you treat tax there. But in Australia, everyone had killed their grandmother for a tax deduction. People buy into strata with tax issues in mind, and it's pretty relevant in the current budget and what's going on, discussions about negative gearing and capital gains tax. So tax has been a really important reason as to how you get in. Why don't people consider the after-tax cost of that funding decision and the impact it makes on the profile of their levies? Now, I hope I've raised more questions than I've answered, and I've deliberately, Gemma, ignored your question because I just don't want to go into, oh, here's three things and here's three other things. Funding can be a bit more complex, but before we all get too worried about it, if we're thinking about that word return on investment, the first thing to get right is the right project. Whether that's $100,000 or $1 million, and there's a choice between the two, getting the project right is going to have a huge impact on your return on investment. The next one is to get the right contractor. No, this guy at $90,000 is not necessarily better than this guy at $110,000. Work out what's important there. Getting the right value contractor will also have a big impact on your return on investment. And of course, the after-tax cost of funds also will have an impact. I'll better shut up or I'll keep talking all day. Sorry, Mitch.
Good segue for you to have another webinar about all of these topics.
Oh, thank you, Gemma.
Mitch, I liked your comment that insurance is meant to be there for sudden and unfortunate events. So when thinking about bigger maintenance issues, how can an owner's corporation satisfy the insurer when there are known defects, though they're still in that decision-making process?
Sorry, just for my clarity, are you saying how can owners corporations satisfy the insurer when there's known defects, but they're trying to decide the pathway forward?
Yeah, they're in that sort of middle road trying to make a decision to go forward. How do they satisfy the insurer then?
Yeah, it's been an interesting watch evolve. In 5 years, say 5 to 7 years ago, the insurance market had a lot of patience. They understood that big works required big decisions require a lot of money. Nevertheless, that has shifted somewhat. There's been a lot more impatience, I guess, emerging because insurance companies don't necessarily want to, kind of carry that risk whilst decisions are being drawn out. It's difficult because the decision-making process across strata is quite complex or quite delayed. I guess what I would say is then if there's not material action happening physically on site to remediate these items, there needs to be action happening toward progress, right? The way that strata runs doesn't necessarily mean we just delay decision-making. We need experts, we need advice, we need consideration of how we're going to fund these programs. So in absence of things occurring on site to fix the issue, a strategy I think that the customer would need to deploy is bringing the insurance market on the journey about what's involved in the decision-making process to give them comfort there's no unnecessary delays, and all the delays that they are seeing, there's a reason for that.
Yeah, perfect. Thank you. Paul, you touched on owner buy-in and that being a big part of the journey. Working with so many OCs over time being at Lannock, do you have any practical advice that you can give to gain that owner buy-in for this major works?
I probably have it in the negative. And I think most people, when they start in strata, when they start as an owner, or when they start on a committee or as an office bearer, or when they've got a great idea, let's paint the foyer pink or whatever it happens to be, naively think, oh my gosh, this is such a great idea. Everyone's going to love it. It's going to be unanimous. And then after a few discussions, they realize, well, let's get towards consensus. And then after a few more discussions, they realize there are some people who are always going to disagree. So I think the first thing would be, look, jump to that stage, realize that you are not actually going to be able to bring everybody on this journey. There are people who will not like what you're doing for all sorts of reasons, from ignorance to they've got a better idea to lack of funds, whatever it might be. And some of the reasons will be very pertinent. There'll be people who do not want to do what's going ahead. And you actually have to accept that. Now, as Stephen Goddard, who was the initial president of the OCN, used to say, it's the most basic form of parish pump politics. You need to get engagement, and in the end, you need the required majority at the general meeting, whether that's a special resolution or an ordinary resolution. You have to psychologically accept the fact that not everybody is going to agree. And I think a lot of the procrastination and the delay is caused by people initially wanting to say, let's get consensus, let's get unanimous here. and the lack of that stops things from proceeding. I don't quite agree with this comment about, never let perfect being the enemy of good. I'd actually rather go for better than good, but you're not going to get everybody on side except that from the beginning.
Good. Yeah, thanks. I'm sure that strata managers or owners that are on this meeting can use some of that advice. Mitch, could you touch on just how have the regulatory changes and compliance requirements impacted the way that insurers assess buildings now?
Yeah, this has been really interesting to see play out, actually, because I've just described a moment ago that there's been a reduction in patience across the insurance market. And then we had the DBPA, for example, which is creating delays. So what I observed occur was it took the market a little bit to catch up on the new legislative environment and the delays and the additional steps required to move towards remediating a lot of these issues. At this moment in time, it's like I said before, we really need to be considered in the narrative that we're telling the insurance market. In absence of the context, in absence of the storytelling, insurers will just think nothing's happening. So that's why I'm a big advocate for these kind of I always say ecosystem solutions. Let's discuss, get your broker, get your strata manager, get your committee, get your financier together to help build the narrative and then bring the insurance company on the journey with everybody, because that's when they start to understand the reasoning. If there is a legislative change that has delayed progress, there's a reason why. In absence of knowing the why, often we're held at ransom of bad outcomes, whether that be policy terms, insurability, or pricing.
Perfect. All right, so we have some good questions here now from the people that are on the webinar. So we have, what if the insurer is impatient for the works to be done and refusing to provide terms? However, the OC is still waiting on professional assessment. We have confirmation of assessment, booking and inspection, but still waiting on the report from the OC to review. How can we move forward in general terms, obviously?
Yeah, it's a difficult one without knowing kind of the nuance of the issues. What I kind of think when I hear about that question is that the insurance market has probably known about this matter for a while and perhaps is evaluating the risk as too large, and they want maybe an opportunity to not continue to carry that risk. I think what urgently needs to happen is the broker advocate or whoever it is really needs to evaluate what's happening. Like I said before, rebuild the narrative of what's been happening and reapproach the market on that basis. There's a couple of things that we've got levers, like we can do big excesses, change the policy terms and conditions. Perhaps the broker can go outside the standard panel of strata insurers, noting there's a lot more general insurance in Australia outside of just strata. So it is quite nuanced. I think it's important that it's dealt with very promptly. I think it's about building the case, building the narrative, and also expediting what we can.
Yeah, perfect. So we have got someone saying another seminar sounds great, Paul. But to segue to that, are there funding options for a committee that is divided? Some want to pay up front for building remediation projects, while others do not have enough cash to do so and need to borrow funds. Is there a product that we can cater to for both lot owners?
Oh, that is a very loaded question, that one, in the current environment. So yes, there is a product there. It's called a hybrid loan. And having said that, let me put on record for everybody here my absolute distaste of that form of funding and my view that it is completely inappropriate as a financial product in strata. So, well, yes, there's legal opinions on this, and somewhere or other there's a speech that I put together on the topic, and it is a complete seminar in itself. But let me just go through a couple of the options and what really is the practical solution, or a couple of the problems there is. I think one of the issues is it creates two classes of owners, sets them off against each other. and with potential conflicts of interest. If in the future you're one of these lending owners to the corporation, what happens if everybody in the committee is a non-lending owner, or vice versa? Or what happens when the committee is, somewhat evenly split between these lending owners and non-lending owners? It's potential for divisiveness there. There is also the issue of by definition, a lending owner is going to benefit from the corporation. They're going to be paid interest. That's going to be a benefit. And therefore, that puts some, depending on the jurisdiction you're in, some pretty severe restrictions on what can and can't be said in committee meeting by the people who are intending to obtain this benefit. Look, there's a number of regulatory issues where we think these products don't comply, as well as being a number of other issues. But I think it actually simply comes down to this. If a special levy is the right thing for your corporation in your situation, and remember before I talked about the pros and cons of each of the funding options, but if a special levy is the right thing, then doing one of these mishmash type products in order to give some people what they want, which is, oh, well, we're a bit afraid that some people won't be able to pay the special levy, let's do this. No, I don't think that's a good idea. The people who can't pay a special levy should look to other forms of finance, such as to their mortgage and things like that. That is a better solution. Or if the right solution of funding in another situation is to have a standard loan, but people are thinking of this mishmash of stuff because some people want to euphemistically and erroneously pay up front. Those people who want to pay up front would most likely be far better off with some kind of other investment with their money. For example, a term deposit with a bank, which is 100% bank capital guaranteed. These products tend to be more expensive, so why should everybody have to pay more for a product which by definition only suits the needs of some? I think that's another product with it. Look, I could go on for a long time. I think it's probably better if anybody has questions about this, contact Gemma or me, and then we'll start the conversation and give you some of the core documents which we have to talk about these. But probably, look, I'll take off my modest hat. Lannock is the leading strata lender, has been for the last 20 years. We are the most experienced, we have the most resources, we have all this sort of stuff. If we have all these resources and we are more respected and all those things by the community than other people, why are we not offering this kind of a product? And there are very good reasons why we don't.
I think it's many difficult decisions, but obviously they're living in a community, so they have to make a decision for what's right for everybody. Mitch, another one for you. If a building has major works coming up, will the insurer likely want to get involved in strata decision making, such as if the contractor is selected for the project? If the contractor selected for the project is suitable, and if they have sufficient funds, etc.
Great question. The insurance company is not going to want to be involved in the decision-making process as to which contractor or builder to use. The second part of that question was, will the insurance company want to see the funding plan for that?
Yes.
That is something they may very well, the insurance market may want to see that. The broker might be using it to build the narrative, like I mentioned before. And that's more of a newish kind of concept. Insurance companies getting a little bit interested in that. That's why we're very much encouraging the planning process. Where are the funds coming from? What's your special levy kind of schedule? And in absence of that, where are the funds coming from? So I guess in summary, I've not yet seen a case where the insurance company wants to be involved in the decision-making of contractor or trades, etc. But I am observing they're becoming very curious as to how they're going to pay for these works. Because a lot of the funding type discussion was a lot of the reason for the delays or the word later. So they're trying to circumvent that a little bit and hold owners corporations or body corporates to a little bit of a higher account of getting things done.
Yeah, we find in a lot of situations, the owners corporations will come to us to consider the funding option at the very last point. We sort of want to encourage the discussion, how are we going to fund this further up the line? We've got another one for you, Paul, which again is kind of pushing on your expertise, but how can we determine whether a strata loan is more suitable than a special levy?
Okay. Where do I start on this one? Look, for those interested, get in touch and we'll have a simple one-page PowerPoint slide with the pros and cons of each of the options. So that's one thing. Another one is to actually sit down, probably first as a committee, and say, well, what are our priorities here? Is it after-tax cost or pre-tax cost, or is it timing, or is it just the way people feel? Some people feel that they hate the idea of debt, and that's an important part of the decision. Other people want the cheapest cost of funds, and that's a worthwhile thing as well. Sometimes debt, or often debt, is the cheapest cost of funds, and so those people have got a bit of a problem there. I think the other one is, look, we are slowly introducing an app called Levy Planner, which is a very good thing to talk about that. But again, Levy Planner is a whole nother webinar, so let's not take it out here. But that takes all the principles that we talk about at corporate finance and of tax, does all the calculations for you, and just enables you to see the impact on your levies and the tax benefits of the proportions of funding by this way, that way, or the other way. So that's another thing which can work out. Is that sufficiently addressed where you think that question was going, Gemma, or have I missed something?
No, I think so, but I think you're probably right. This is the beginning of a bigger discussion. So we probably need to have another webinar topic on that, which we've got a few comments saying, yes, they'd like it. Sending another one back to Mitch. Is it common for a building to be told no one will offer insurance due to major defects? If so, are there any immediate steps that you can take to convince an insurer to provide cover?
That is not happening frequently at all, but it certainly does happen. I've actually seen numerous examples of it about to happen. I think we've always managed to kind of mitigate that happening or circumvent that concept. I see it more and more frequently when things are delayed, and through that delay, they actually become worse and worse. And then specifically if we're in an environment where there's no funding available and there's no interest of the owner's corporation to move toward fixing it, I have seen insurance companies decline to renew and other insurance companies very disinterested in providing cover. I think first and foremost, I think it's really about establishing dialogue with the current insurer as to what has led to them to make this decision, and understanding their thought process allows us to better kind of respond to that or figure out what action to take immediately to try to change their mind. Concurrent to that, the owner's corporation, the strata manager, or their broker should be really aggressively considering contingency options, whether that be from typical strata insurers, whether that be from atypical strata insurers, whether that be from insurers that are APRA regulated in the country but don't deal in strata, or whether that be going to Lloyd's of London or other offshore mechanisms. I guess in summary, it's not common. It does happen. There's often a reason for it. Find out the reason, try to overcome the reason at the same time as urgently figuring out what you would do if that first approach doesn't work.
Yeah. We have one that has a very quick answer. Can Lannock attend meetings with owners and committees to answer any queries and questions they may have? Yes, of course, always. We have a strata manager on here. As a strata manager that suggests a strata loan is an option for remediation, how can we dispel the myth that the loan company will take their units if the loan defaults?
Okay, I don't often hear that one, so I'm pleased to hear that it's actually popped up. Let's just go back to a fundamental. The owner corporation or a couple of fundamentals, and Gemma, give me a push along if I'm taking too much time here. The owner corporation is a statutory body and it is required, it's obligated by legislation to do certain things. And we've known for, the big one is repair and maintain. And as in the strata sector, I don't know how many times a day we say that, but repair and maintain the common property. It's a legislatively mandated obligation. It is not discretionary. The same with insurance and things like that. Then it's a matter that because the corporation must fulfill these obligations, it has a revenue raising capability, which is levies from owners. It doesn't matter whether the item which is being funded is the heating bill, the power bill, the cleaning bill, the roof fixing bill, or the cladding rectification bill. They all come in the fact that they must be paid by owners in unit entitlement. Simply put, the choices are a small number of large levies or a large number of small levies. We understand the first being special levies. The other one is contributing into a sinking fund or servicing a loan. But basically, it's small number of large levies or large number of small levies. It also then is an overlay of what is the cost of those levies. Now, a levy is never free. It always comes from somewhere. If you're going to have credit card debt at the end of the month because you've paid a levy, that's the cost of your payment of that levy. So levies have to go in. It's just a matter of choosing the small number of large ones or large number of small ones. And then the other aspect is after tax, what is the cost of your levy? And I think if we start thinking that way, we'll be making better financial decisions in strata. It's only a small component, but it's one of it. And also if we start, and I didn't go into this when I banged on about planning in the first part of the presentation. If we start thinking about this carefully for the future. At the moment, most approaches to that future item of capital works is one of denial. I don't really believe it's going to happen. I don't really want to think about it. I don't want to make a decision. Decisions need to be based on cost of funds, availability of money after tax, rather than ignoring it, putting your hands in your pocket and not ever taking them away. But the more people can plan for the future and say, look, we have this thing coming up in 4 years' time. Right now, we're pretty comfortable about having a special levy for it. That's a great idea. That is planning. Or let's contribute, the exact amount of funds or half of it or whatever into a sinking fund. Or no, we're seeking this, and this from borrowing from our attributes of funding. We want to borrow in 5 years' time. That planning is really, really good.
Perfect. Mitch, if a building has multiple, major issues that they're currently rectifying or need to rectify, can you provide any insight into how the Owners Corporation should prioritise those from an insurance perspective?
Yeah, that's a really relevant question. I, off the top of my head, would advocate for bringing the insurer or the insurance market or the broker along for the ride. Like the reality is, if you've got combustible cladding, you've got an associated fire order, you might have water ingress related defects and something else that might be cosmetic. We need to really consider how the insurance market is evaluating each of those buckets, so to speak, and figure out which of those buckets is attracting the worst perception of the risk, right? Often I understand, especially for new builds, you've got cosmetic matters within units that owners are really, really, really eager to fix because they've just bought into a beautiful apartment. Sometimes the common property related structural defects are critically more important to sequence. So it's very, very much case by case. I think, like you said before, Gemma, it's very much about just bringing the professionals into the conversation. Get the broker there, have a meeting with the broker, get the broker to engage the insurance market in a really collaborative and constructive way to help determine which of the various issues are of most concern to help inform the decision-making process as to what to sequence first.
Yeah, perfect. Look, we only have 4 more minutes left of this webinar. So even though you've both shared some great insights, is there one key message that you'd like everyone to take away when they're deciding between now and later, and what would it be? Paul.
Oh, okay. Look, I've got 20 key messages. I picked up in the point in my presentation about changing the attitude, changing the language, thinking about investment, therefore return on investment. I think there's a very strong parallel to that, which is thinking about the people who are going to, let's just call it contract. That's a really brutal word, contract with you. Not thinking of them in terms of these people are an expense. Now, let me get the cheap one. But this person is an investment partner or partner in my investment. Let me talk with them. Now, Mitch has talked a lot about taking the insurer along for the journey. And I have just been so impressed. I've known Mitch for a little while now. But in this presentation, who would not want Mitch to help you in your insurance journey? And I think the notion of treating the service provider you have as partners rather than those people over there who I think they're going to screw me, so I'm going to try and screw them, that's never going to get the best outcome.
Perfect. Thanks,
Yeah.
Paul. Mitch, your last comments.
For me, it's appropriately full circle. I think Paul opened with the themes I mentioned, like, planning and engagement. Those, I think, really fundamental and the common messaging here. Like, we plan for so many things. Let's plan about how we're going to fix things. Let's plan how we're going to fund it. Let's plan how we're going to engage with the insurance market. And let's collectively work on the solution together. Paul's mentioned a lot of corporate finance type words, which I'm a layperson in that context. And it makes me curious as to me talking about insurance concepts. It must be a difficult role of the strata managing agent who's at the meeting trying to bring together all of these disciplines at one. And I think what we don't do enough of in our space is get together, have the conversations as a collective to solve problems as a collective. So let's plan better and let's engage more strategically at owner level, but also services and supplier level.
Yeah, absolutely agree with that. So thank you both for a very insightful discussion on this topic. This webinar will be shared with everyone who registered and online so that you can share it with those, the owners corporations that you're associated with, and help them understand the potentially costly impacts of delaying any works required. Thank you both so much for today, and we hope everybody has enjoyed it and has a great afternoon.
Thank you so much.